we're really excited after a father of Forex to have a father of prop trading here. The industry has been subject to growth due to the affiliates and influencers that basically has been referrals to the other companies. Now these affiliates, they became owners of the business basically for themselves rather than being just affiliates.
In and around 2021, Roman, as you state, we had already launched at that time probably 12 prop firms, a number of which were social influencers. So they were immediately able to disseminate that message out very, very quickly to tens of thousands, if not hundreds of thousands of listeners. When you run an introducing brokerage business, you're always referring someone else's business. My business was built on the success and reliability and the continued hope that broker that I was sending business to would pay me for that service. But I didn't own anything. I didn't own the brokerage. I didn't own the platform, the liquidity. I didn't even own the client. And I just want to tell my funny Drew Niv story. So this was probably in 2017. And I remember sitting down with Drew in his office. And I said, I don't want you to wake up one day and realize you don't need Justin sending you business anymore. Drew looks me dead in the eye and he goes, I don't need you. And he paused for about a few seconds. And then he goes, but I like you and my people like you and our clients like you. So we have no interest in cutting your business. And
now the industry is self-harming, I would say, just by dropping the consistency rules, dropping the news trading restrictions and so on, which makes some random traders so easy to clarify for the funded accounts.
So am I hearing this correctly? Easier to launch, harder to run than the brokerage?
I think that's a very apt and correct statement. Yes. If you have very sensible and sustainable rules, it's actually very easy to run.
Justin, FBFX in 2016, when you were servicing that first client, what was the MVP and what is it today?
We said, hey, we've got this automated solution. Maybe you guys are willing to be our test case. They agreed. And so when we rolled it out to them in August of 2020, they were able to start cash flowing more than $1 million a year on an annual run rate within about 6 weeks of launch. They were a 3-person company that was able to scale and remain a 3-person company.
What do you think would be the healthy month-over-month payout versus revenue ratio of a healthy prop firm?
So it's a great question. And, the industry somewhat exploded from there. I mean, we've since launched over 150 prop firms, and I think the industry is somewhere north of 200 these days. And it's growing in popularity and awareness by the day.
Hi, everyone. Welcome to the third episode of the Dealers Connect podcast, presented by your lovely host, Elina Pedersen and Roman Garanin. And we're really excited after a father of Forex to have a father of prop trading here. So basically, the plank is very high. Let's just start it. Welcome, Justin, and we're really excited to have you here.
Well, thanks for that ridiculous introduction. I hope I can live up to that, but it's a pleasure to be here. Thanks for having me.
All right. I truly believe that this is the case. So in any case, however we end up, it will not change. So let's touch the beginning of your career. As far as we know, you started in law. And could you please give us some of insights on that area?
Yeah, happy to. So I think with most people in the FX CFD space, they ended up there by accident. Very few people seem to intentionally start out in that industry. And as you mentioned, I started my career as an attorney doing securities and commercial litigation. And my reason for that was growing up as a kid, my dad was an entrepreneur. He started a business when he was 19 that he still has today. And, growing up in that house, I saw the pressures and stresses of everything that he was going through, and he, wasn't shy about sharing with me the sleepless nights he had, worrying if he was going to be able to, keep this house and this family together with all the challenges that he was facing. And so he pushed on me and my sister to become professionals, and so that we would always have a career and we wouldn't be dependent on, the ups and downs of running a business. And so I went into law, my sister went into accounting, and I started my career in that capacity. But I found out very early on I was a bit more entrepreneurial than your average attorney. And in 2009, left the practice of law to join a currency trading prop firm. And that was my first exposure to trading anything. Fell in love with markets, with the brokerage side of the business, and just decided that was a better fit for my skill sets and my interest. And from there, started a NFA, FCA, and ASIC regulated introducing brokerage business, which I had for a little over a decade before moving into the prop tech side of things. And coincidentally, not coincidentally, my sister, who started out as an accountant, since became my CFO in all the businesses I've ever started. So, despite my father's best efforts to keep us out of entrepreneurship, we ended up there.
So here you are today, being the father of
Yes.
prop trading.
I'm afraid that moniker might not leave after this podcast.
Eventually, Justin, so as you said, you turned to prop trading. Was it a traditional prop trading firm? Like, what was the business case back then?
That one was sort of a hybrid. It was actually part of the overall transition we've seen over the last few decades, where prop trading has been around for a very long time, and it used to be where the best and brightest mathematics and computer science students would be, plucked from college and university to join investment banks or trading firms, and given a, more or less an unlimited budget in a low latency, high technology environment to figure out how to make the firm more money. When I got started, it was transitioning a little bit over to the retail side, where this was a physical trading room led by a number of former hedge fund managers that were moving into the sort of education and mentoring side of the space and trying to develop the next great hedge fund manager, if you will. And so there were some similarities between the old world, where you did have to qualify and go through an application process to be admitted, but at the same time, you paid for education, you paid for your seat, and so you were not, there as a sort of a hired employee. You still had to earn your way through the program. Um, and and then I think, with the advent of better and better technology, the physical trade room in general has largely gone by the wayside. Now almost all the trading groups, even some of the best and most notable traditional institutional prop firms, are remote as well. So that was how I got started. It's obviously a little bit different now when you take on retail traders, but it was all part of an overall transition into what we see today.
So how did you come up with the idea of retail prop trading? Or how do actually tell us a little bit about, yes, how you got started with that?
Uh, yeah, happy to. So in 2016, my current partner in our tech business joined our brokerage business, and when he came over, he brought with him a number of institutional relationships. One of which was really one of the first retail prop trading firms in the world. Very, very innovative, very ahead of its time, and they were big in the future side of the market, but wanted to get into the FX side and didn't know much about that world. And so we helped them with everything from setting up an offshore company, getting an MT4 white label, uh, connecting them with a broker, and then for several years, we basically helped them with their operations. And in doing so, we got to see behind the curtain in terms of the commercial model that they were running, the cash flow that it generated, the workload that was required to operate the business, and all of the back end trading and risk activity that was being generated by their traders. And this was a very successful firm, but our main takeaway was that everything they were doing was manual, and because this was a very attractive value proposition to retail traders, it attracted an audience, but they had to hire dozens and dozens of people to really run the business effectively. And if you guys have ever been a part of large manually run businesses, you end up with people tripping all over each other, and you get very inconsistent messaging, and people assuming someone else is going to do something, and then ultimately no one does something. And in a day and age where you know e-consumers are expecting instant gratification, the bigger that this firm got, the less of a positive experience the traders were having. And so we looked at this and said, well, all of these major workflows that are needed to run one of these businesses could be and should be automated. And so we brought in our third partner, who's an absolutely brilliant technologist who's been doing development work for banks and brokerages for over 30 years. And I joke he's our genius in residence and can take the crazy ideas in our head and make them a reality. And he was able to basically program and integrate a number of different applications and third party vendors into one seamless customer experience where we automated everything from uh, the e-commerce transaction to account creation, to reading back trading metrics, to displaying them in a trader dashboard, and then acting upon those metrics based upon preset plans or rules that the prop firm had put in place. And our first iteration was something we actually started building without a spec and without a client in mind. We just thought that there was an opportunity, if we could automate this type of workflow, that we could enable smaller operators to scale their businesses faster and farther through sales and marketing efforts rather than from just the day-to-day management of sort of administerial tasks. And that was really the genesis idea. You could call me the father of prop trading, but we weren't the first. We were just the first ones to come in and automate the workflow to really socialize this type of opportunity and allow smaller operators or ones focused more on efficiency to come in and do it effectively.
So, Justin, FPFX in 2016, when you were servicing that first client, what was the MVP and what is it today? Like, how did it grow? What was the first product you developed?
Yeah, so actually that first client that I was describing was someone that we serviced on the brokerage side of my business before we
Okay.
even started the tech company. But it was the catalyst for forming the tech company. And in 2019, we actually started to develop this end-to-end automation. We brought it to market in August of 2020 with our first client. It was a small trading education firm that we'd worked with for many years on the brokerage side, that wanted to get into prop trading, but like everyone else in the world, was trying to do everything manually. And we said, hey, we've got this automated solution. Maybe you guys are willing to be our test case. They agreed. And so when we rolled it out to them in August of 2020, um, they were able to start cash flowing more than $1 million a year on an annual run rate within about 6 weeks of launch. So it took
Oh,
them from
wow.
just doing all of this work manually and taking on, one client at a time and having to go through all the various steps to onboard them and monitor them, to really just focusing on the marketing side of the business and driving traffic. And so for them, it was a great success. They were a 3-person company that was able to scale and remain a 3-person company. But for us, it fully validated our thesis that we could enable these smaller operators to enter the space that typically required much more overhead, more personnel to run these types of businesses. And at the time that we had that first deployment, there were maybe 8 retail prop firms operating in the world, all of which were doing things either manually or some sort of hacked together internal solution. We were the first SaaS provider to enter the space, and I think that's really what helped to catapult this industry, is that we did make it accessible and available to those early adopters to come in and take advantage of the value proposition that prop trading offers to retail traders. And the industry somewhat exploded from there. I mean, we've since launched over 150 prop firms, and I think the industry is somewhere north of 200 these days, and it's growing in popularity and awareness by the day.
I think you gifted us Sorry, I think you gifted us with the renaissance of the effects industry. Thank you, Justin.
To the extent that I played a small part, my pleasure.
Especially the technology providers are happy, I believe now. Okay, speaking about the evolution of the industry, Justin, you mentioned that it was basically 2016 when you started it. Me personally, I have started seeing some cases like FTMO and stuff. I would say late 19 or something like that, 18 maybe. But I would say truly started booming end of 2021, I would say early 2022. So how would you describe from your side the evolution of the industry? Let's say like 2016, like almost nobody knows about the industry, and then like how did it evolve? Maybe you can provide us some numbers from your
Yeah,
side.
and this is my interpretation of things. It may not be rooted in reality, or different people might have different feelings about what led to the rise of the industry. But you did have some very early adopters who were extremely innovative in their space, FTMO being one of them, five percenters being another, that were very early, saw the opportunity, created successful businesses around prop trading, and were largely operating in very successfully, but in relatively small communities. Their businesses hadn't really exploded to the levels that they are seen today, because it was just a function of awareness. And I think awareness these days, it can be tied ultimately to momentum and marketing. So if you're a new operator and a small operator in a new space, it takes some time to build up your marketing. It builds up time to penetrate and resonate enough times with new audiences to get them to start working with you. But like any other industry, once you start having a few more people and a few more people move into the space, they're helping to create more and more overall awareness for the industry in general. And in and around 2021, Roman, as you state, we had already launched, at that time, probably 12 prop firms, a number of which were social influencers. So they were immediately able to disseminate that message out very, very quickly to tens of thousands, if not hundreds of thousands of listeners. And for many of them, this was a case of first impression, but it was an incredibly compelling value proposition, and something that, on its face, appeared to be much more exciting than a traditional self-funded brokerage account. And that was basically that big first domino that started to really drive the market, because retail traders who had heretofore only known self-funded accounts as the way to express their views in the market and make money through trading now had another option. And that other option was quite attractive, as compared to the somewhat attenuated process of opening up a brokerage account and making a significant wire deposit, and trading on conditions that were sort of ever changing with the evolution of new regulations coming down from some of the major jurisdictions. And so I think it was just that right time, right place, where we had the technology that made it available to so many people. And then those operators doing a great job of marketing to audiences that really were interested but had just never heard of it.
Okay, but like I would say that 2022 to 2023, there is a very big boom. Like 2023, I would say it's like last year was like I don't know, maybe 5 times industry expanded. Why do you think is the case, and why exactly these years? And okay, let's not go to the future yet. We will discuss if we are peaking now or not. But let's focus on this.
Well, I think the growth rate is similar to, say, the adoption of crypto, going back 10, 12 years. It was only known by a handful of people, and then it slowly caught on, and then it had some momentum, and the price started to move, and all of a sudden people started to look at it again. You're absolutely right. 2022 to, let's say, the first half of 2023 was an explosion. It was month over month growth of around 17%, across at least the firms that we serviced. When you compound that, that's tremendous numbers on a 12-month trailing 12-month basis. And it became a a situation where you did have those early adopters that happened to be, big social influencers and other, big marketeers that were able to push the value proposition out there. You had others who were historically in, let's say, the affiliate business, that were jumping on and saying, wow, I can be an affiliate to these businesses. And so they started promoting it to their networks. And then those affiliates decided, I don't need to refer this business to someone else. I could be in this business myself. And so they started to open their own firms, and it became, not in a negative way or in any way like that, just a game of follow the leader. The momentum was so great, the opportunity was there. They could see the numbers, they could see the web traffic coming into some of these sites, they could see the prevalence of the ads through the various marketing channels. That if you were in the marketing space and you were in financial services, um, you couldn't not pay attention. And I think it captured the interest of so many people in the space that it just became the hot topic.
So,
Cool. So
Justin,
basically, this is just. Sorry, Elena. Just let me summarize this. It's a good point that we didn't. I don't think that it's commonly known. So basically, the industry has been subject to growth due to the affiliates and influencers that basically has been referrals to the other companies, and currently as a more simple setup of the business rather than, let's say, brokerage companies. Now these affiliates, they became owners of the business basically for themselves rather than being just
Yeah,
affiliates.
and you've connected the dots, and I can speak from my own experience, having run an introducing brokerage business, for years. And actually, I'll tell you a great Drew Niv story, because I love this one, and you guys just did your podcast with him right before me. So when you run an introducing brokerage business, you're always referring someone else's business. My business was built on the success and reliability and the continued hope that broker that I was sending business to would pay me for that service. But I didn't own anything. I didn't own the brokerage. I didn't own the platform, the liquidity. I didn't even own the client. The client belonged to the broker that I was referring to. And so when you run an introducing brokerage business, you don't own anything, and it makes it very hard to market aggressively because you feel like your world could be upended at any moment. And I just want to tell my funny Drew Niv story. So this was probably in 2017, and we had our NFA license, and the NFA and CFTC regulations for operating a regulated brokerage in the states were quite arduous. And when Dodd-Frank was passed in 2009, we saw the industry go from basically 40 regulated brokers down to 3. And I woke up in like a cold sweat one night thinking, okay, there's only 3 brokers I'm sending business to. Maybe they just decide there's not enough competition here to justify having an introducing broker anymore, and they're going to cut my business one day. So I made an appointment to travel to New York and New Jersey, meet with the CEOs of FXCM and the other 2 operating brokers at that time. And I remember sitting down with Drew in his office, and I said, I just want to let you know, my name is Justin. This is the business I run. We have a great relationship with FXCM, and we've got a significant book of business with you. And I just wanted you to know, who I am, and that there's a real company behind this, and it matters to us, and our relationship with you matters. And I don't want you to wake up one day and realize you don't need Justin sending you business anymore. Drew looks me dead in the eye and he goes, I don't need you. And he pauses for about a few seconds, and then he goes, but I like you, and my people like you, and our clients like you. So we have no interest in cutting your business. And they never did, and it was a great relationship that lasted for years and years. But it was a very blunt and direct conversation exactly about what my fears were. And to your question, Roman, um, that's sort of the issue, is that if you want to be in financial services these days, between the regulations and the overhead and all of the things that you have to have in place to actually run a business, it's incredibly expensive. It takes years to do it right, at least in a major financial jurisdiction. But with prop trading, you could have a business essentially in financial services that you could get started essentially with a website and an e-commerce page. And for a lot of people that wanted to be in the space and wanted to have the ability to promote their own brand as opposed to someone else's, this was that avenue.
Okay. And that's a very good point that it's actually just a lot more, well, a lot cheaper and easier to launch a prop firm. And I think when we spoke briefly with Drew about it, that was his opinion as well. Now, Justin, I know that one of the main value propositions of FBFX is risk management. And this podcast is a lot about risk management. So I wanted to ask you, uh, based on your standpoint of view, what's the biggest difference between a standard brokerage risk management and a prop trading firm risk management approach?
Yeah, so the basic drivers of risk between the two operations, brokerage and prop trading, are fundamentally different. And we realized that very early on, and we had the benefit of having been in the brokerage space for a while and understanding that side of the market. But if we look at a very basic example, ultra basic example of brokerage risk management, let's say, Alina, you go long gold, and Roman, you go short gold. You're both at the same brokerage firm. The broker finds both of your flows to be very toxic or very hard to deal with. Worst case scenario, they set off your positions against one another. They capture the spread. They capture the commissions. And financially they'll be okay. They're just not monetizing your business to the extent that they might be monetizing a more benign retail trader flow. But in prop trading, when two traders get to a funded account, it's the prop firm's risk capital that's at risk. And so if Alina makes money, and Alina is going to be paid out 80% in what she makes, and Roman, you lose on your account because you're taking opposite positions in the same asset, then the prop firm makes only 20%, let's say, if they A-book everything, Alina, when you make money, but they lose 100% when Roman loses money. And so when you look at prop trading risk management, if you wanted to A-book everything, you'd have to be right around 90% of the time just to break even on your funded accounts. And no handicapper in the world, no risk management firm or in-house, trading desk is going to be right that often when it comes to which accounts to A-book. So you have to look at it a little bit differently. The other thing is because you can't have the benefit of set off, you are vulnerable to traders out there that are going to try to create those heads I win, tails you lose scenarios. And so you have to contend with different types of risks related to copy trading, reverse copy trading, latency arbitrage, statistical arbitrage, traders working in concert with one another. In addition to just the overall trading risks of, this trader has a funded account. Do they make money? Do they lose money? And so um, we've had to look at things very differently. We've hired a number of people from the brokerage industry that have sat on risk desks to come in and help us with managing risk for our licensees. And they all come in with very firm preconceived ideas about how to manage risk. And then as soon as they get exposed to the things we're looking at and contending with here, they realize, yes, it is very different. And it's not a problem that can't be solved. It's just a problem that you have to be a bit more flexible and open-minded to solve. And we've had the benefit of some incredibly bright people that work for us and have developed all sorts of models and flags and trading strategies around prop activity to help firms to better monetize and mitigate risks. We've also developed all sorts of um, flags around different types of suspicious activity that not only help us to uh, identify some of these toxic traders and bad actors in the space, but also to raise awareness to our licensees about where they're being affected and that they might want to consider perhaps adding some rules and conditions into their program that are making them somewhat susceptible. Very easy cases. We might be able to measure that news trading is accounting for 20% of losses realized by a particular prop firm, but they don't have any news rules around it. Well, generally you want to deter any sort of, gambling, coin flipping type activity with a prop firm. And so we might say, hey, look, this is where you're being particularly hurt. Here's some of the types of news trading rules that we've come up with. We're happy to implement these or implement anything else that you have in mind along those lines. But it's something we strongly recommend you take a serious look at. So that's sort of the approach, but it really is different. You can't just operate a B book quite the same way that some of the brokers can, and hope for the best. Because also one of the fundamental differences you have is asymmetric risk. And what I mean by that is a trader might buy $100,000 challenge for $500, but if and when they make it to the funded account environment, and let's say you're giving them 50-to-1 leverage, now they're commanding $5 million in buying power, and you're allowing them to lose, let's say, 10% on that account, so $10,000. And so you need revenues a lot from the challenge side to offset some of the risks that you might be taking on that funded environment. Um, and a lot of the early adopters that were some of the initial licensees of our technology, and even firms today, they don't have a significant enough appreciation for that asymmetric risk. But that's something that doesn't exist in the brokerage space at all. And so you really have to weigh uh, the passage rates and the qualifying of the traders, and the A booking and B booking of traders, and how you leverage some of the other trading strategies, hedging and alpha generation strategies that we've developed against the funded account risks that you're now carrying.
So, am I hearing this correctly? Easier to launch, harder to run than the brokerage.
I think that's a very apt and correct statement. Yes.
Yeah.
It does not mean, but I just want to clarify, because I don't want to, obviously for my own self interest, but in general, I don't want to deter people from the space by thinking it's harder to run. If you have very sensible and sustainable rules, it's actually very easy to run. Where you can sleep great at night, knowing that you're going to have a business that's going to continuously make money. It's a statistical business, and if you understand all the permutations and likely outcomes in law of large numbers, you can run a very successful business where everyone wins. You win, your affiliates win, the end traders win, with no risk of not receiving their payouts or anything like that. What has happened as the industry has grown is that you did have a lot of adopters that came in from backgrounds other than financial services, and without a full understanding of risk management in financial services businesses, that really engaged in a race to the bottom. They made their trading conditions easier to attract traders. They lowered their prices to attract traders without any full regard for what that meant on the back end. And they came in typically undercapitalized at the outset, and then they created a scenario or circumstances that were essentially unsustainable long term. That's the issue when it comes to managing the business, that we see, and that's why you've seen so many firms this year come and go. Is that they were really lacking in those two areas. They were undercapitalized, and they didn't have a significant enough appreciation for risk. If you come in with capital, and if you come in with an understanding of how risk works in trading, you can and should do very well. And that's why we've seen and been the beneficiary of so many regulated brokerages that have now entered the space and have prop trading as an ancillary offering to their traditional brokerage businesses.
Can we specify some of the top risks that we are speaking here? I would give my, let's say, and just what lays on top of my head. Like, for example, I would say that the most important, the hardest risk to identify and to manage is basically kind of external hedging patterns that we have among the clients. This is, in my opinion, one of the most tricky parts. And of course, I would say that now the industry is self-harming, I would say, just by dropping the consistency rules, dropping the news trading restrictions and so on, which makes some random traders so easy to clarify for the funded accounts. And eventually the prop trading firms, they're just basically flipping a coin and cannot assess anything, in fact, like, because like the people, they are passing the challenges with just one news release, and we cannot say anything about the client. So eventually I do believe that it's a dead end if the industry goes that way. But do you see any further patterns that you would say that we need to keep an eye on?
So overall, great observations. We are seeing many of the smarter firms addressing some of those exact things that you mentioned, Roman. So they are starting to put in place different types of rules that promote, let's call them better trading activities that are removing the likelihood of just flipping a coin, and now they're forcing more consistency, uh, which is a good thing. It's helping to actually qualify better traders, which leads to more predictability in the funded account environments as well, which also helps with the risk management side. What you want to eliminate to the extent possible is just the randomness factor, as you're describing. You don't want coin flipping, you don't want gambling strategies. Overall, these are not demonstrations of good activity. What what is a bigger problem before you even get to, let's call it, hedging strategies, is statistical arbitrage. And in that race to the bottom, many firms out there have opened themselves up to statistical arbitrage just in the actual structure of the plans themselves. It has nothing to do with the price feed or the execution quality that they're getting inside of the actual trading environment. It's the plans themselves are fundamentally flawed, and that is leading to a significant amount of erosion in overall profitability and margin due to um, some very bright people with a good understanding of mathematics coming in and taking advantage of these stat arb opportunities. So to the extent that we just kind of chatted about some of the changes that firms can make in their rules and conditions and metrics by which they qualify traders, these do act as deterrents, and they close the window of opportunity for these stat arbors. So those are some of the good things that are happening. But that's actually the first port of call when it comes to shoring up your business, is to try to put through better qualified traders and eliminate the people that are just flipping a coin inside of your environment. The next step is, to your point, around hedging strategies and what we call alpha generation strategies, where, can you actually monetize the data that's coming through your prop firm? Can you use that in any meaningful way to cut off your tail risk, to normalize your cash flows, to reduce your overall payouts as a function of gross sales? Can you actually use the data to generate alpha and just pull value purely from the market itself? Um, we've proven the answer is yes. We've been developing strategies now for about 2 years that we're just rolling out to our licensees that will do all of these things. But that, in my opinion, is the next evolution of the space. It is becoming a real financial service, and it is becoming one that requires competent risk management at the controls to drive the overall profitability. It was a sales and marketing business. It was a technology scaling business in the early days, with the competition, um, with the need to provide traders that balanced opportunity of something that is very attractive, but at the same time reliable in the sense that they can trade with you with confidence. Risk management becomes central to the operation.
Justin, so if we look at payouts versus revenue ratio, what do you think would be the healthy month over month payout versus revenue ratio of a healthy prop firm?
So it's a great question. The sort of optimal area, and this is more sort of backwards to forwards. The optimal area is if you're between 30 and 40% of your gross sales in the form of payouts. That tends to indicate that your program is rather attractive to traders on the one hand, but also does a fair job of qualifying traders on the back end. And so if you can find yourself consistently in that range, you have a quite healthy business. You have good margins to cover your marketing costs, your operating costs, platform fees, liquidity fees, and all the other costs of just running your business, and with a good degree of predictability as well, which is also important, because if your fluctuations in your cash flow month over month look like this, it makes it very hard to manage your business with any consistency, because you don't have any consistent cash flow. But if you're in that 30 to 40% payouts as a function of gross sales range, you tend to have good visibility into what the future of your business looks like, and you can intelligently reinvest in new marketing initiatives, or bringing on new people, or making other capex investments.
Great. Let's touch the future of prop trading now. So actually, we had a question like if prop trading is here to stay or not, but I will not ask it. I will ask how it will be in 1, 2, 3 years, how it will look like the industry. And the other question right away on the spot, do you think that the instant funding model that is appearing here and there, is it sustainable? Is it something that is here to stay, or is just another spin-off of the brokerage and prop hybrid?
Compound question, good questions in there. I do believe that the industry is here to stay. I think there's enough critical mass of interest these days that firms are now starting to look to embrace it. Brokerage firms are looking to embrace it when before they were sort of shunning it. I think the conversation that some of the regulators are having in some of the major jurisdictions is actually healthy. That they're now starting to look at it critically, but I think they'll look at it from a perspective of regulation as opposed to prohibition, let's say. Um, Instant funding is a really interesting one. Instant funding can be extremely profitable for a prop firm and create a great opportunity for a trader if run properly. My biggest issue with instant funding is that it could be argued and perceived as an end run around leverage caps because that's effectively what the trader is receiving. They're putting up $2,000 to command a $10,000 account on 100 to 1 leverage. All of a sudden that's 500 to 1 leverage. And we've seen other firms that have, even more egregious conditions where you're saying, well, this is a 2,000 to 1 levered account. And all the money lost is essentially the prop traders. It's not the prop firm going at risk. That's my biggest concern with instant funding. Um, it is somewhat of a horse of a different color than a traditional self-funded account, and arguments can be made to the other side and in favor of the prop firm that's offering it, as well as the benefit that's being presented to the trader that's venturing into it. But that's my concern in it. But I can tell you, for the firms that offer it, again, if structured properly, very, very effective and very attractive.
We know that one of the biggest contributor of industry adjustment would be the regulation. We will touch it later on, but is there any other factors that you consider would be yielding, let's say, in terms of how it will change next couple of years?
I think even regardless of regulation, which we fully embrace, I look forward to it because it's going to weed out a lot of the operators that don't really belong in the space. This is a serious business with serious financial consequences, and it's bad for the industry when these firms pop up and disappear, inside of a couple of months because they didn't have the capital and they didn't understand the risks, and everyone gets hurt. Mostly the end traders. So we fully look forward to the day when regulation is here, and we've built out our technology to comply with whatever is required. But I believe even before that, I think we will continue to see more regulated brokerage firms enter the space. And I think that we will see more pressure for standalone operators to successfully operate in the space as a result, because in a competitive market, you need to achieve certain economies of scale. And the brokers already come in with infrastructure that's largely portable and applicable to this business, in the sense that they already have trading platforms and liquidity and marketing teams and compliance desks, and they have payment processing relationships, and they have a database of dead, dormant, and demo leads that they could market to. They have IB and affiliate networks that they can tap into. They have decades of history that they can trade upon and say, yeah, we've been around since the early 2000s and we were regulated in these 7 countries. You know who you're dealing with. And so when they come out with a competing value proposition to one of these standalone operators, I think it puts them on better footing, and I think it makes them have a much more cost-effective position to operate one of those businesses, as compared to a standalone firm that has to go out and pay to acquire all those clients in the first place, and they've got to pay for trading platforms and pay for liquidity, and they're going through all of these expenses for the first time. They can't say to their their compliance officer or their general counsel or their head of marketing, hey, go figure this out, because they've already got them on payroll. They have to go and hire all these people. And so if you don't have that uplift early on in your business to support all those fixed expenses, it's going to be very hard to sustain your business. Whereas the brokers have that in house already. They can leverage that. They can leverage the momentum of their core business. They can leverage their $1 million plus marketing budgets to give the viewers of those ads now effectively two bites at the apple. They've got two ways to monetize that client, through a self-funded account as well as a brokerage account.
Uh,
Pardon, a self-funded brokerage account and a prop account.
yeah, and they can actually remarket just the current traffic, let's say, right?
They can remarket. There's also the opportunity for cross promotion, in the sense that it could be, purchase a prop challenge and get 6 months commission free trading when you open a self-funded account as well. There's different incentives that they can offer that a standalone firm would not be able to do.
Yeah.
Speaking
So I
about
think that's one of the big trends we'll see. Pardon.
speaking about horses of different colors, I appreciate the horse reference there. Thank you, Justin. I was wondering, like, for me, instant funding really looks like a regulatory arbitrage. Like, it looks like a regulated activity, as you said, with just a higher leverage. It doesn't look like an educational activity, so to say. So, speaking of regulations, where do you think we stand today, and how far away are we from actually having a framework to regulate retail prop trading?
I think that's a great question. I think that's the one on everyone's mind, because we're all looking for guidance ultimately. Uh, you know, Historically, we've seen oftentimes the U.S. leads the way in terms of new regulation. But we just had a presidential election. We have a new administration starting in about 6 weeks' time, um, and and so it will take time in the U.S. for any meaningful legislation to be passed. And even if it is passed, there's always some future point in time when that legislation becomes effective. So we might not see anything meaningful in the U.S. From a legislation standpoint for about 2 years at the earliest. And that's discounting the fact that we have what many would perceive to be a very pro-business administration coming in. We do have the CFTC case against my Forex funds, which has been ongoing now for a little over a year. There may be some precedent-setting um, uh, guidance that we could get from that case if it goes to a conclusion. But there were some articles, I think, a week or two ago that talked about the likelihood of a settlement, and that being somewhat imminent. And so that may be just another case that settles where we don't actually get any meaningful guidance as far as what we could do as far as best practices, or what any prop firm operator could do as best practices. We've seen a number of regulators and central banks in Europe and other parts of the world have made comments over the last 6 to 8 months. And I do think that we could see in some smaller jurisdictions some new regulation around prop trading. But then that begs the question, will it just be specific to firms operating in that country and not necessarily servicing residents of that country? So you have the same offshoring that you see in the brokerage environment, where yes, UK says this and Europe says that. We'll just have our office in Seychelles, and we'll give the client the option of where they want to choose, and so that regulatory arbitrage persists. Ultimately, would love to see some sort of pan global regulation that does raise the entry requirements, because I think it would be great for the industry overall. And I could see those being around, um, minimum net capital requirements that you have to have based upon the amount of funded accounts on your books. I would love to see transparency around the risk management side of the business, so traders and regulators know how much money is being held by the firm, where it's being A booked, where it's being B booked. I'd love to see regulation around promotional materials, and making sure that every claim and every piece of collateral material that's put out by a firm is tenable and defensible by that firm, and not cherry picked, or not intended to manipulate the end trader, or take advantage of them in some way. All the same stuff that we largely see in the brokerage space in a lot of ways. I'd love to see around prop. I just would like to see it with some intelligence around the specific nature of how the prop industry works, because that is a little bit different than brokerage in that sense. And I would love to, to the extent it's possible, I'd love to be part of that sandbox where, those ideas are discussed and policy is proposed, because we'd love to see this industry flourish. I think it absolutely should. It's an intriguing value proposition to all parties involved. Um, but we need to have, some checks and balances and policies and procedures to hold everyone accountable, and protect the end consumer.
In terms of the case that we have mentioned, it's basically the MFF case that has been there for like a year or even more. Okay, maybe not on this specific case, but in general, what prop trading firms do need to do and follow today in order not to get in troubles tomorrow? Like what are the key check boxes, let's say, to be ticked?
I think the first two are really easy and commonsensical. You can't manipulate the trading environment to your benefit. You have to operate at an arm's length, which means you don't have a hand in the pricing or trade execution that your traders receive. And the other is you have to make the payouts. When a trader comes through and absent some clear violation of your terms and conditions, you have to pay them out. You can't find convenient reasons to not pay people out. And that's what you see from so many of the firms out there, is that they have to decide between paying out a trader or going out of business. That's literally where they are. And so they're choosing to not go out of business.
Mm-hmm.
But if someone were to challenge them on those decisions, they would not be able to defend that position. And much the same way that if a broker were to claw back gains made in an account that violated some T's and C's, you have to be prepared to defend that position when the regulator comes in and that client, files suit, let's say, to support your position and the decision that was made. Um, and so the same has to be applicable here. You have to pay out the traders, and that needs to be top of mind when you're running these businesses. And if you are in a position where you can't do it, it probably isn't the space for you.
Can we elaborate a little bit the first point regarding the payouts? It's very clear for everybody, but regarding the first point in terms of manipulating the platform environment and stuff. So, like, what is considered to be a manipulation? Let's say if we have different liquidity pools for different account sizes and stuff, do you consider this as a manipulation, or this is the kind of unacceptable market practice?
I think the specific example that you just raised there, different liquidity pools for different size accounts or different traders, is where you really get into the gray area and expose yourself to some potential problems. If you think about prop trading in the institutional sense that we kind of talked about at the very top of this call, a prop firm is a customer of a brokerage or an exchange environment. They are not in control of their liquidity. They are a price taker of the trading venue where they're trading. And even though this is retail prop trading and the prop firm itself is arranging all of the infrastructure for their prop traders to trade on. They're providing the platform. They're deciding what liquidity they're using. They obviously are carrying the risks of the funded accounts and so on. I think it's absolutely critical that you always remain at an arm's length on the pricing and the execution. And the more you start to manipulate that, and the more you create new categories or conditions by how trades are routed in certain ways, the more someone could look at you and say, that sounds a lot like the activity of a brokerage firm managing risk, and you're not a brokerage firm. And I
Yeah.
think that's one of the major issues that the CFTC took with the My Forex Funds case. And I think that's a lesson to be learned for any operator in the space, is to run the pricing and the execution at an arm's length. And
Mm-hmm.
the prop firm should always be a price taker in that sense.
Okay, very good
So,
point. So basically, there is no space. Sorry, Elena, finalizing. Promise. So there is no space for the prop trading firm that is basically acting as a prop trading firm and the brokerage, as we, I believe, have a lot of market.
I wouldn't say there's no space. I think it's a matter of risk appetite and disclosure. The more you do what you're describing, Roman, the more risk you bring to your firm potentially. However, you can counter some of that with disclosure. So if you put clearly into your terms and conditions and your trader agreements, we reserve the right to do the following, based upon your account size or your activity. And if it's done in a systematic way where it's not done on a trader by trader, trade by trade basis, where it's only to the detriment of that trader, for example, I think you win back some points, and I think you can argue very effectively that um, that this is not activity that's done to hurt anyone. This is activity that's done standard across the board for anyone fitting this criteria. Um, and I do think that helps. So again, I still think that's a little bit in the gray area, but transparency is one of the things that every regulator looks for, whether you're regulated or not. Right? There's not any regulator in the world, financial or otherwise, that can't come after you, or that any financial or other regulator in the world can come after you if your marketing is deceiving, if your terms and conditions are taking advantage of a consumer. Um, and so this is one of those areas where the more transparent you can be, the more clear you can be in all of that documentation. And if you're consistent throughout all of your marketing in that way, I think you create a more defensible position than not. But it does still raise some potential risks.
So I think in all of that we've touched upon, let's say, three topics that are very common within the brokerage space, which are treating customers fairly, best execution rules, and capital adequacy. So it's all very, very common things within any regulatory framework, which are completely absent currently, or please correct me if I'm wrong, in a retail prop space. That's one part of my question, I guess. And the second part is more around capital adequacy. But for me, it's really hard to understand how can potentially capital adequacy be calculated for a retail prop firm.
Yep. So the first part is all of those things are largely common to regulated brokerages and should be taken seriously by prop firm operators. But there is no regulation that I'm aware of at this point that sets any hard and fast rules and requirements that a prop firm has to meet in order to operate. And again, we hope that will change in time. But that's from a regulatory perspective. From a good housekeeping perspective, what should you have to operate one of these firms responsibly is still something in the control of an operator. Um, and we we typically tell firms that the amount of capital that is needed to really start one of these firms is largely dependent on your rules. The riskier the rules, the more capital you really need to start. The less risky, the less capital. Um, but at a very uh, base, recommendation, we tell firms, your starting capital should be at the time of launch. You should have somewhere between 150 and $300,000 of available capital that's not tied up by personnel, marketing, payments to tech providers, and other regular expenses of yours. This needs to be money that just sits in your pocket, sits in a bank account somewhere. That is your net capital reserve. And then we've helped them to come up with a formula that allows them to build on that net capital reserve as their business grows and as the liabilities on the books grow. And basically, there's a percentage of gross sales over a rolling period of time that firms should retain in that net capital reserve to ensure that, in law of large numbers, based upon the expected outflows of their business, that if their sales funnel were ever to get cut off, they would have enough net capital reserve to make a payment to every trader that they have on the books. And that gives them time to maintain their reputation, to not violate any law or regulation to which they might be subject, and to basically give them time to fix their operational issues and get back to bringing on new clients. So that's sort of the good housekeeping approach that we take, and we tell this to every firm that we work with. Some of them tell us, yeah, absolutely, we've got more than that, and no issue. And then you find out, they'll just say anything to get into the space because they just don't believe it, or they think we're too risk averse, or whatever, and you still have clients that end up in bad situations, or firms that end up in bad situations with clients ending up in worse situations. But yes, you can you can bring, you know, good business sense to these businesses and run them properly. And there are plenty of great examples of firms that run their businesses properly and put away money for a rainy day, you know, just in case there is a disruption to the business.
Justin, I would like to get back uh, to the clientele. From what do I see, it is a bit different from the brokerage industry. I would say just younger. Even Drew mentioned that his son was one of the clients of the prop firms.
One of your clients.
So, like being 13 years, being 13 years old, yeah, probably indirectly even your
I hope
client.
not, but
Let's see. But anyway, I do see that the clientele is a bit different. They are like, and further to that, I see that there is a race of these more hipster platforms, if we can say so, appearing here and there, like a side of MetaTrader. What would you say from your side? Is it truly different, or it's still the same clients and profile?
it's a great observation. I'm actually amazed you were able to glean that from your perspective in the space. But it is largely the same audience and largely the same, call it, personality or psychological traits that you find in the brokerage space, but it is shifted about 5 to 7 years younger overall. So you tend to see a lot of 20s to mid 30s make up. We had the percentages. I wish I had it in front of me right now. That's about 70 something percent of the traders that you find inside of a prop firm would be basically, I think, 35 and under. Um, and I think that is a generational thing. I think we're talking about a generation of people that have much shorter attention spans than the generation before them and the generation before them. It's also a generation of traders that um, don't don't fully subscribe to, you know, the concept of compounding and continuing to do the same thing successfully and grinding out wins over a career. They're looking for um, get rich quick. They're looking at influencers. They're looking to live a lifestyle at a young age that's largely unattainable for 99.99% of all people out there. And so prop trading offers that appeal of it being like a lottery ticket where you could take that small amount of capital and command a great amount of money. I think it's also, though, a generation of people that don't believe in letting other people make decisions for them. We've seen that overall trend in people taking more control over their financial destiny. First, working with sort of, you know, AI retirement account managers and moving away from traditional wealth advisors, and just making their own decisions. And so now more than ever, I think the younger generation of traders believes in themselves, perhaps too much, that they are capable of making sound financial and investment decisions. And this is one of those opportunities that looks very, very attractive, and more attractive than grinding out in a self-funded account or investing money in a business or the stock market and, you know, making 10% a year. That's not as interesting as what this offers.
Yeah. And in terms of trading platforms, I see that prop trading clients are less attached to the MetaTrader. Of course, there are some, let's say, very straight reasons behind that that are coming from MetaQuotes. But do you think that in general, these clients are less attached to the to MetaTrader as the forex people?
Yes, absolutely. I think that uh, the growth of the space, coupled with some decisions that MetaQuotes made earlier in the year, have spurred the growth of a number of competing trading platform companies, and exposed hundreds of thousands of new traders to new platforms. And I think people generally are creatures of habit, and the platform that you use and get comfortable with becomes the platform that you may end up using for your career. And I think if we look at this also being an audience largely of um, influencers and affiliates that are driving this space, if these are the platforms that they have to choose from, they'll develop their education businesses and their trading signals and tools to work for platforms other than MT4 and MT5. And then you get following generations of traders that will now learn on those other platforms, much the same way that MetaQuotes and MT4 and MT5 have sustained to a great degree on um, generation after generation of trader learning and using the tools and the EAs and the scripts that were made available by the education groups that they learned how to trade from. And so you have new entrants to trading, learning from new people or accessing the market from new prop firms where the first platform they come in contact with is not MT4 and MT5. And I think it's a great opportunity for those new platform providers to showcase what they have to offer. And I think it will lead to a greater democratization of trader and trading platform, because you won't have such singular reliance on MetaQuotes as to the extent that you did before.
Justin, I think you shared a lot of invaluable advice with us already, but I'm just wondering what would be the top three takeaways for the industry newcomers from from the father of prop trading.
That's going to
I'm gonna
stick,
keep calling
unfortunately.
you that. Yes, I'm gonna keep
We
calling
will
you
make
that now.
sure.
From now on,
I'm going to see you at an industry conference, and that's how you're going to introduce me, and it's never going
I will.
away.
Yes,
Um, I think it comes back to a couple of things that we have touched upon. Um, Again, the two big things when you want to launch as a prop firm operator is you need to have sufficient capital and you need to have a real appreciation for risk. I think the other thing that you have to accept is that the gold rush is over. The opportunity is still there, but the gold rush for literally anyone just hanging out their shingle and saying that they're in business is not there anymore. You have to have an audience that you know that you can tap into. You have to believe that you can achieve significant ROAS on your marketing. You have to be able to withstand a somewhat slower uptake in the adoption rate of your offering. It's not just build it and they will come anymore. And so if you come in with the right amount of capital and you come in with appreciation risk, but you also come in knowing that this might take 6 to 8 months to really ramp up into something, and that you're not going to be cash flowing a new Lamborghini to yourself in month two, then you've got a good shot of being successful. But you have to be realistic when you approach the market. And I would say similarly, for end traders, to the extent that they make up some of your audience that are looking at how do I choose which prop firm to work with. um, a lot of the same stuff that I would tell traders back when I had my brokerage businesses. Well, there's information that's available. Figure out who the principals of the company are, figure out what they were doing before they got into this business, figure out how long they've been in business. Look around and ask yourself, does this sound too good to be true? And if it does, it usually is. So do a little bit of due diligence. It's your hard-earned money that you're putting at risk. Make sure you're putting it with a responsible firm that is going to deliver on its promises to you.
totally agree. Thank you, Justin. Roman, any more questions from you? I'm
I
satisfied.
do have a question. The last
Okay,
one, though.
okay, go
I
for it.
promise it will be a last one. Justin, we know the prop is um, cheaper in terms of user acquisition than brokerage. And actually, I wanted to ask it earlier. Just sorry for keeping it for the end. Is there any possibility to provide us some references for different regions, for different what the companies should be targeting as the CPA or CPL, like how to measure their efficiencies of the marketing activities?
Yeah, really good question. So we're seeing, and I'll just break it down generally to tier one, tier two, tier three countries. Um, Tier one countries, cost of client acquisition um, could be anywhere from $300 to $500, with an LTV typically around $2,700. Tier 2, you want to be in the um, about 125 to 275 range, and you're getting an LTV around 1900. And then client acquisition costs in tier 3 countries are ranging anywhere from uh, about $25 upwards of about $175. And LTV tends to be around $900 to $1,100 for those traders. So there's still really good ROAS opportunities from a marketing standpoint to be had. Now, those are blended rates, and a lot of that is also anecdotal from the conversations we have with our licensees, because we don't track their marketing analytics. But those are blended rates when you factor in display ad, pay-per-click, affiliate-driven, um, social marketing, and influence. So some channels and avenues could obviously be more expensive than that. Others could be virtually nothing to acquire a particular client. But the interesting thing is the LTVs of those clients tends to be pretty consistent with the LTV of a self-funded account from those particular tiers. Um, and I guess the psychology and the dynamics around why that is with a lower cost of client acquisition is that you are removing a lot of the barriers to entry. The cost to acquire a client for a self-funded account, where they're forced to first go through the trader agreement, then submit their KYC documentation, then have to make a significant, let's say, wire deposit or alternative payment method deposit, because they need to have enough capital on the account to trade with the leverage they want and put on meaningful trade size. Here, one of the things that prop trading has hit on is reducing the transaction to as simple as buying a t-shirt online, right? Within about 30 seconds after purchasing, and for a relatively smaller amount of initial money, um, you're up and running with a trading account in about 30 seconds. And removing those barriers brings people in, and then they're just more apt to purchase again and again and again, where we see the average individual purchases around 3 to 3.1 times. So you're not just getting them that initial time; they will pass or fail and repurchase again and again and so on. And that has led to a very comparable LTV, but again at a lower cost of client acquisition.
Very insightful reply. Thank you very much, Justin. And I think we're fully covered with everything. I'm sure the people out there will be happy to get these insights from
sending
the first
inquiries
hands.
to FBFX.
Yeah, we will add the link to your website below the podcast, so that they know where to go.
and if they could address me as dear father of prop trading, in the message would be great. No, but I think guys, this has been a pleasure to sit with you, and the questions have been great. I think you've hit on so many of the central themes that are happening inside the space, and we're all interested to see how it evolves. I just hope it ultimately ends up in the right hands that are good caretakers of the future of prop trading, because it is a great opportunity and value proposition for operators, but also for the end traders. And I think it can slot in right alongside traditional brokerage, if done properly.
Absolutely agree with that.
I agree. I think we just need more positive publicity, a little bit more positive publicity.
And awareness of the risk managers out there, because if they enter the space without actually knowing the risk, that's basically always harmful for the industry in general, which I believe we have to raise. That's what we're trying to do, actually, even with this podcast as well.
Thank you, everyone.
Well, guys,
talking to you.
Yeah, Alina, Roman, thank you for having me. It's always a pleasure to chat with you guys, and I hope the listeners enjoy it as well. And just again, appreciate the opportunity.